Hello, everyone. How's it going? I'm J. Scott Scheel, the founder and president of the Commercial Property Academy, and really excited to be here with you folks on this live Q&A. This is not something that I have conducted before, so please forgive me in the event that we have some technical hiccups. But I think my team and I will be getting this together here very, very shortly. And again, looking forward to answering any questions that you may have, granting any insights. Excellent. Eric, thanks for joining us. Jack, Sigiri, good to see you all. At the end of the day, some of my team members are going to be here. I think they're going to kind of help me limp my way through this. So, if you'll bear with us for just a moment. All right. Thanks, Kathy. I appreciate that. Eric, good to see you, sir. Hope Dad is doing well. God bless. So I think the idea is for this to kind of be open Q&A. So maybe we can, get ready to, ask some questions, get some prompts. I think, again, my team members should be back here momentarily. As of right now, I am not picking up questions, so I don't know what we've got to do here. Hi, Faria. Good to see you, hon. Jules, we'll be conducting another event in the eastern half of the United States. It's not going to be until first quarter of next year. We have begun looking for locations in the New Jersey area, New York, New Jersey. We've got a great constituency there, so that might make it a little easier. And originally we were anticipating that we would be in Cleveland, but we got bumped through a large convention that came in the one weekend we had available. And so that event has migrated to San Francisco, which has really been our number one market for the last 21 years. So a lot of folks are going to be going there, so it should be good. Bill Schilling asks, is there an asset class that I would avoid in this market or any regions to avoid? And my feeling is this: you don't really want to find yourself in a position where you're just avoiding asset classes, but you would use an extra measure of scrutiny in certain asset classes, and those would be those that are really suffering right now. That would be retail, hospitality, and central business district office space. Those are the ones that I think are experiencing the greatest amount of disruption. And then on the flip side of that coin, the concept of getting in late in the game in industrial or storage or mobile home parks, those cap rates have been compressed down just so tightly that there really is no opportunity for them to go anywhere else but probably to expand, which I think most people will find threatening, because with interest rates rising and cap rates expanding, you put yourself in a position where you have two very powerful forces working against you. So I think that, that would be, how I would look at it. But other than that, it's just basically a more intense standard of due diligence and a higher level of scrutiny to really cherry pick the deals that I think make the best sense. Now, Ashley Jones is asking if I feel that this market is looking good for retail, and the answer to that is absolutely. I am bullish on retail. I am currently in the process of conducting leases on, what will amount to nearly 300,000 square feet of retail space. That square footage is going to equate to about a $27 million gain in value. So we're pretty excited about that. In addition to that, I feel like that is the least valued real estate right now, and it has all of the demographics that I like. It has best location, it has good infrastructure, good traffic counts, presumably, and it has all of those things that make a ton of sense. So definitely bullish on retail, but once again, you got to make sure that you know what you're looking at. And to a certain degree, my feeling related to that retail is, it's not all created equal. Some of it is going to be retail that you're going to want to repurpose as retail, and some of it you're going to want to reposition so that it can become something else in the future. But again, the price per pound is going to be excellent and very attractive. Locations, traffic count, infrastructure, usually pretty attractive. Scott, can you give us a recent example of some opportunities in the repurposing of commercial space where one could focus their attention? Well, there's a lot of them. And I think that's what a lot of people have been missing out on. A lot of people want those deals that are already, kind of done for you. When you do that, you're going to pay full price. And so, tons of big boxes that are open. I've recently done several repurposings of big boxes, including logistics for industrial warehouse and distribution. We've done light industrial. We've done storage repositions. We've just scraped the dirt and let someone come in and redevelop the land altogether, which has also been an excellent opportunity. We've done conversions from old Central Business District office to hospitality. We've done old Central Business District office to multifamily, and all of these are within the last 3 years. Since COVID and maybe just a little before COVID, those really started taking place. So a lot of opportunity for repositions. I see Faria is excited about us finally getting back to New York and New Jersey. Last time we were in New Jersey was early 2019, so just before the pandemic. It's been a little bit of a, I don't know, hiatus, but we're excited to get back. So Mike is asking, Trent is asking a question, and these keep bouncing. Any CMBS defaults? Yeah, they're starting. We just saw Blackstone give back $300 million office tower. We saw an $80 million office tower in Houston go. Both of those lost nearly 80% of their value, so those are starting to come. And you're going to see a lot more of those. There's many of those that are already in the workout. They've been kind of working their way up to workout, but they are squarely in the crosshairs of default now because there's just no place to take them. And with interest rates rising and underwriting starting to become a little more intense, you're going to really see that a lot of the lenders that are out there, they just don't want to get involved again. Even if it's a low-price debt structure, they're not necessarily interested in getting involved. So, that's a big issue. Congratulations, Eric. I was talking with Mike Carrasco the other day. He told me that you and Joseph and Liliani are going to be closing on the Peninsula Town Center. That's awesome. Congratulations, brother. So happy that we could marry up two fantastic individuals or couples and marry this up in a way that makes a ton of sense. Holly Hines is asking a question. She says, if you have residential and commercial real estate in Massachusetts and want to purchase like but larger property in Florida, but turnkey, so what do you recommend? Hang on, somebody bounced that question. Let me get this back in queue here. Um, she says, what do you recommend in order to use your equity in Massachusetts to purchase in Florida so you don't have to liquidate? And can you have good LTV ratios with lowest rates? Refinance, cash out, mortgage bank, or mortgage lender? Okay, a lot of questions there for Holly. So absolutely, you can take your equity in Massachusetts and position it in Florida. Problem is, in both of those markets, prices are at historic highs. And so any liquidation you have here, unless you're a strategic buyer, if you're buying something that's turnkey, you're going to be paying premiums. And in Florida, premiums are a big deal because Florida is a market that tends to rise and wane. Now, obviously, many of you are probably aware that there's a quote unquote positive political environment down there where they behave differently during the pandemic than a lot of other places. And because of that, they found themselves in a situation where they became kind of the belle of the ball. Everyone wanted to go to Florida, so it drove prices up. It really drove demand. But now there's a ton of spec product that's coming on, so it's going to be a product by product basis for evaluation, and it also is a market by market. Not all markets moved equally, even though Florida did quite well in all of its major population centers. You know, the central part of the state and some of those tertiary markets, they moved in ways that they've never moved before. And so disruption and potential disruption to absorption and climbing interest rates, supply chain disruption, which will cause costs of construction to go higher. Those are going to be playing a bit of a tug of war with supply and demand. And Holly, those elements together are going to mean that you're going to have to be very selective, and you're going to have to find the right asset if you want to take equity in Massachusetts and then turn it into turnkey in Florida. As far as good LTV ratios, you know, you're in the 70 to 80% range, unless you're dealing with non-stabilized assets. And then for refis, do you get cash out? Sure, you do, not necessarily on acquisition though. And you're gonna have to demonstrate that you've added value. So you can't buy it today, you know, at some discount, immediately create value, and then pull all of your cash out. That's something lenders are gonna be sensitive to now. And then I'd work with banks, mortgage lenders. I'd work with insurance conduits. If it's a non-stabilized asset, bridge lenders. So those all work pretty well. Jules McKenzie, there's a lot of vacant retail properties in our area. Should we be searching through these for best opportunities, or should we be researching potential tenants to occupy these properties first? Well, it's always nice to have a user in hand, Jules, when you're going to acquire an asset. But if the fundamentals are there, it really doesn't matter. The fundamentals are good. You've got, great density. The issue that you have to deal with is, are you getting a tiger by the tail? And when I say that, that means, look, you've got control of the asset, but it's unruly, and it can really turn around on you and eat you if it's too, let's say, too voluminous in its size compared to your likelihood to be able to turn it around. So you want to be prudent in the way that you engineer the transaction. So I love retail, but there's a big difference between a vacant 3,000 square foot out parcel pad with its own parking, its own curb cuts, its own existing building that can be repurposed, and let's say a 900,000 square foot interior corridor mall that's lost all of its major anchors, and the folks that are in there now are the ones who weren't fortunate enough to negotiate escape clauses or kickouts in the event that someone didn't do the job right. You're very welcome, Holly. Glad that could help. Hopefully I answered it to your satisfaction. If you have a follow-up, please feel free to present it. Eric's asking a question. He said, I'm just 15 years old and I want to get into real estate, so what do you recommend that I do to get into real estate? I'll tell you the very best thing that you can do, Eric, is to educate yourself. Get involved and start to understand what you're talking about. The concept of where you can be 10 years from now at the age of 25, the ripe old age of 25, is really spectacular. And you're in a season right now within the market cycles that is largely going to present immense opportunity that you probably haven't thought of. It's certainly not something that anybody who's been in this business for the last decade or so has ever experienced. This is valuation shifts. This is disruption in the financial markets, disruption in the lending markets, and soon to be disruption in the equity markets. So those are all things that are going to be favorable to someone who is value add if they are kind of getting in for the first time. But what you'll want to do is you want to understand how those deals underwrite. You want to start to break down those numbers, get a real sense of how you will evaluate the income and the expenses. Start to become intelligent and conversant when it comes to the links that you're or the leases that you're going to be dragging through, and what covenants matter. And again, the first time you read these things, everything is going to be Greek to you. But in a very short period of time, as you continue to read through and grind through them and consult with folks, this is going to become second nature to you. And I can tell you that every lease that you sign on a pure commercial asset is worth hundreds of thousands of dollars at a minimum, and more than likely millions of dollars as you move forward. So it's worth learning what you're reading. And then, Eric, I guess the one last thing that I would tell you is get out there and do some practice deals. Start breaking down projects that you really know you have no chance of acquiring, but that you still are able to gain some insights as to how those will work both now and in the future. All right, Deshaun Cunningham, you've been telling us to get liquid for what's coming down the pipe. What are my thoughts on the process of lines of credit on our equity versus having actual liquid capital in the bank? Equity lines are just as good as cash. Obviously, the difference is you're going to pay for them when they're deployed. The other part of it is that historically lenders have been aggressive about either reducing or eliminating those lines of credit when the market starts to shift, coming back in and doing a reappraisal or freezing lines at inopportune times. So those are some of the, let's call it, traps that you want to be aware of when you're looking at those things, Deshaun. But right now we're looking at that balance of liquidity. We want some liquidity, no doubt, but you don't want to find yourself overly heavy in cash, because at the risk of sounding alarmist, there is currency risk as well. Inflation is eating away at your purchasing power, and we always talk about that. And more people are worried about inflation eating away at their dollars and what they can buy than I think should be, because what they're forgetting is that on the other side, even though your purchasing power may be slightly diminished because of inflation, when values start to come down, they'll come down much faster than inflation will take those bites out of your dollar. And so I think that you're either going to be on par or a little ahead if you've got the capital to pull the trigger on deals that you truly are excited about investing in. All right. Let's see, we got anybody else in here that's got some questions for me? And I'm not necessarily seeing them, guys. All right. So XYZ wants to know, what's my take on multifamily in South Texas? How much of a price, cap rate discount should I look for now and still be able to turn around and refi in a year at a much higher interest rate? Well, all right, so there's a lot there to unpack. The idea is, multifamily in South Texas is strong because Texas, again, is another one of those political climates that's been very attractive compared to, let's say, the other 48 states. I think Florida might be the one entity that stands a little head and shoulders above Texas because of the, let's say, the guidance that's been granted through the leadership in Florida and Texas. And so, cap rates continue to compress. It depends on the quality of the asset, but you're somewhere in that, look, I'll give you an example. I just sold in December with some partners a 240 unit brand new facility. And when I say brand new, we deployed it and started leasing it in 2019, just prior to COVID. And we sold it for a 3.2 cap in December. Now, that's an incredibly compressed cap rate, and it made sense to them because it was, again, a brand new asset in a hyper positive market of Austin. So we're a little further. That's kind of central Texas. But, depending on how far south you're going, you pay attention. And you'll find your cap rates, so should be somewhere in the, 4.25, 4.5 on pristine assets, all the way up to maybe 7 caps on, stuff that's pretty beat up. All of those are skewed compared to historic presentations. And then, as far as turning them around, I would tell you that by next year, you're going to see interest rates in the mid 6s pushing 7%. And so even though you're maybe not as thrilled with the concept that you might be paying 5.25 on certain loans today, those are going to look really favorable in the months and years to come. All right. Anyone else? Brownsville. So Brownsville, McAllen, there's demand. I think the question is, how is that market viewed in contrast to all of the turmoil and turbulence that's going on at the border? The southern border, specifically in Texas, has been a flashpoint for political pundits, for let's say congressional wranglings. And look, the folks who aren't from there, have a fairly negative view of the area and what's likely to happen. And I have some colleagues who have assets in Brownsville, not multifamily, that seem to be doing okay for now, but they're starting to see some chinks in the armor, if you will. And my concern would be, as a long-term hold in that market, it might be a little longer than you initially implied you were looking for. But if you're willing to hang on to that asset for some length of time, I do think that it will always rebound and recover there. All right. So, I would tell you this, the markets are live. They are vibrant. They are moving. There's a lot of capital on the sidelines, a lot of great deals that we're seeing. My leasing momentum is as good as it's ever been. I am currently in the process, let me get this right, of refinancing just about $50 million worth of assets. And, again, those leases, as we talked about, really have the opportunity to generate a tremendous amount of value. I will tell you that my heaviest asset classes right now are retail and industrial. But I am doing some development of multifamily, that is in early in queue, and then agricultural. We're doing a fair amount of agricultural, and we're looking to expand that enterprise into multiple states. Does your course cover triple net leases? Well, Jules, absolutely it does. In fact, in great detail. Triple net leases is the concept that talks about the reimbursements that come back to a landlord from a tenant based upon typically their pro rata share of occupancy of a multi-tenant space, or based upon the rebilling of a 100% tenant occupied space. We go into that in very great detail, again, because we deal with more pure commercial, and pure commercial's office, retail, industrial, logistics, rather than residential commercial, which is obviously multifamily assets and mobile home parks, things, student housing, etc. All right. Anyone else have any questions? All right. So when's the next event? Well, the next event's coming up in Las Vegas, Nevada. I'm going to be heading out there on the 15th of May. It's going to be taking place at the Caesars Palace Resort and Casino. This is our fourth trip back to Caesars Palace. So we're pretty excited to be back. It also marries up against the ICSC Recon Retail Conference. It's the largest retail development, tenant, and realtor and landlord conference in the universe. So getting there makes a big difference, and I would encourage each and every one of you to at least get out to the ICSC show, or if not that, feel free to come to the Commercial Academy, and we can certainly help you out. Sagiri, good to hear from you, hon. The office market has its ups and downs. There's going to be some softness in it, no doubt about it. With folks working from home, the demand is going to be less. Prices are dropping. Landlords are competing far more aggressively. But there is also that adaptive reuse opportunity that we've been a pretty big fan of. And then Shai is asking, we have an opportunity to refinance with a bridge and lock up 4.5 debt. Would you recommend that? If it's a long-term hold, I'd lock up that 4.5 debt overnight. I'm currently looking at approximately that interest rate. Shai, if you want to tell me what the other terms are, both interest rates and um, uh, the loan term based on the length of that term, the amount of that loan, and the asset class, that'll give me a lot better insight. But obviously, as a Diamond Inner Circle member, Shai, if you want to shoot me a text or hop on a call, I'm certainly happy to do that for you. Hey, babe, good to see you. Love you. Very much my pleasure, Sagiri. Thanks so much. Bobby Foltaz. Hi, Scott. This is Bobby from Florida. I've attended 3 CPAs in Orlando. I understand all the aspects of the business, and I'm having, hang on, when these new questions come in, it kind of bounces them away. And I'm having a problem getting my first deal due to not having enough for the financing. I know you discuss owner financing and reverse private mortgage. To this day, I still have not found one deal that will owner finance. Well, let me tell you something, Bobby. I think if you're experiencing challenges there, maybe the way that you're presenting it. We have used owner financing repeatedly throughout our career, and we've done so not only for our own portfolio, but for those of literally thousands of our own clients. So they definitely exist, but you're not wrong when you say that there's a bit of a, let's say, delta between what was available and what was likely with seller financing in the past and where we are today in this hyper sellers market. I don't think a lot of folks see seller financing as a massive stimulator. Give you some examples. When assets go on the market, there are a flood of multiple offers if it's appropriately priced and well positioned, and those come really quickly. So those do exist, but you probably have to dig in a little bit. And in addition to that, if it's a listed asset, it's tougher to get that seller financing because the broker's not going to want to play that game. They're going to want to make sure that all the cash comes to closing so they can get maximum commission. If you're having problems because you don't have enough to put the financing together, one of the ways that we always encourage people to overcome that is by getting to one of our live events. When you come to the live event, you're going to meet hundreds of folks who are out there actively doing this business every day. They have the cash. If you bring a good deal, they're going to hop on board with you. Some of them likely, again, if it's true to form, if what you saw that made you excited about it, made you want to make an offer is really there, then you're going to have no problem raising your capital as long as others see that value the way that you do. The best way that I've found to be able to do that is to break it down in, some sort of a unified tool that helps you understand what you're looking at and conveys the underwriting that you've put together clearly to your prospective partners, because partners can bring a tremendous amount of that capital, insight, experience, relationship to the table. So those are always big positives. Trent is asking, how are you underwriting with your, hang on, these things just keep on jumping every time I go to answer a question. How are you underwriting with increasing interest rates, especially after the first loan term 5 years becomes due? So there's a principle that was put in place during the last market collapse, Trent, that's called stressed underwriting. And I encourage everybody to do this. We talk about this at the academies. Whatever your loan is today, we always want to stress that underwriting. And by stressing it, what we'll do is we'll add somewhere between 2 and 4 percentage points of interest. And we say, look, if interest rates rose like this at the end of this 5-year term and I had to replace it, would I still be able to debt cover? Or if not, how much cash would I have to bring to the table? And how will I build those reserves so that that capital is available in the event that I do need to make some sort of a supplemental payment or principal pay down or some sort of escrow deposit so that my lender becomes comfortable with the fact that this loan is going to perform. So those are the strategies that we've used. We stress it, shorten that amortization from 30 to 25, from 25 to 20, 25, or from 20 to 15. And at that point in time, you'll probably be pretty safe. And then add that 2 to 4 points and see if the asset can still cover it. If it can, you're probably well in safe harbor. If a modest increase of 2% in interest rates causes you to fall below your threshold of standard underwriting guidelines, stabilization, minimum debt coverage ratios, those types of things, you may want to reconsider whether or not that loan is a prudent one for you. Shai on a follow-up is saying it's got an 8.5% bridge to perm on Flex Industrial in Charlotte. I don't have any problem with that. We just want to get you to that 4.75 or 4.5% perm number as quickly as possible. So let's talk what those steps are. If you've got to wait 4, 5, 6 months to get to, a completed or a finished project that will appraise, then you need to be concerned because a lot's going to happen over this next 5 months specifically. So please be careful, and you're certainly going to want to pursue these things with a sense of urgency. To me, that makes a big, big difference because we know the market is shifting. And, I am, as I've mentioned, pursuing a significant amount of financing right now, and we're pursuing all of it with a sense of urgency. But at the same time, we've got a lot of other leasing activity that are impacting those values. So you want to make sure that the financing that you are pursuing is going to line up with what your strategies are, and what Shai is referring to on the Flex Industrial in Charlotte certainly seems like it makes sense, especially if you can get to that permanent rate in short order. What about how to buy any deals that cash flow in self-storage? Well, certainly self-storage is a hot category. We like it because it's more commodity than real estate, asset where you got to try and go out and hunt a tenant and make it the right fit. You negotiate this lengthy lease. Here, it's kind of boilerplate, it's cookie cutter. There's a lot of prospects out there. If you're a good marketer, you should be able to get people to beat a path through your door. If you're appropriately priced, your ability to go ahead and add, revenue to that facility is likely. But the risk there is that they are, again, at historic cap rates, meaning the historic lows. So as those cap rates begin to expand, you start to find yourself further and further into uncharted territory. And if your bank gets nervous, you may have a hard time finding a new lender. Also, as cap rates expand, your value is going to drop. And as your value drops, you may start to chase buyers from the market, and there may be less users when you're done with it. All right, let's see what else we've got. Grace Hayes, when you join Platinum, we'll solve your problem. That's for Bobby. Thank you, Grace. I appreciate the consideration. Rosa McLeod, if anyone is looking for 5-cap plazas on over 10 acres, only 1 and 2.5 hours from Toronto in Ontario, I have 2 off-market listing asking prices, 25 and 34 million in Canadian dollars. Any recommendations, Scott, as to who I should market these? I'm sorry, hang on, guys. Who I should market these to? I'm a real estate agent and investor and have thoroughly enjoyed your live course in the past, thinking of coming to Vegas. Well, certainly, we hope that you make it there, Rosa. We'd love to see you. Depending on the assets, if you're talking retail, if they are stabilized assets, one of the assets representatives that we like to work with when we go to sell, and this has been historically true for the last really 25 years in my experience, is to go with Marcus and Millichap, or at least let them give you a proposal. They have a very special skill set of being able to move money through markets. And if your assets are worth what you believe them to be, or possibly more, I think you're going to be able to tap into their buyers network. They know that they oftentimes are buying assets that are really kind of turnkey, ready to go, and so they're willing to pay top dollar for them. Brilliant. I thought it was just Canadians that stress tested their mortgages. No, certainly, Jules, any prudent investor will be stress testing in this environment, because we know the Fed has been very clear. All the major banks have told you what's going on. Cap rates are going to be expanding because of supply and demand, and the cost of interest rates are simply going to not allow folks to get in at those 2 and 3 caps unless you're bringing a tremendous amount of cash to the table. And that's typically what you get out of top tier markets like California, Washington, D.C., where you can afford to go in and you can buy at a 2, 3, 4 cap, because you're nearly guaranteed over the long haul to gain that cap rate compression back, and that value of leases and rentals are going to continue to expand as the dollar becomes weaker. So those forces together are putting us in a position where it's a great time to test the market. It's a great time to go out there and get your feet wet in a new asset class. But by all means, I don't want you taking disproportionate or inordinate risk. You're very welcome. Glad to be doing this with you. Truly a pleasure. As of right now, I think we've answered all the questions that are out there. I can give you some additional information if that's helpful. Oh, here's one. Scott, what do you think is going to be happening with inflation? Well, I personally believe that inflation's been here a lot longer than the government's been acknowledging it. I never thought it was transitory, and I never thought it was going to be contained at that 4% range that they thought it was. And I've been warning our clients very, very aggressively to be on the lookout and to be prepared with, formed capital, with good long-term low interest rate financing on your fixed assets. And, I would tell you that there is a tremendous amount of turmoil that is coming in the days and months ahead. One of my partners and one of our colleagues, one of our longstanding Diamond Inner Circle members, Sandy Magon, is here. I think he likes me to say Magon. I apologize, Sandy. But Sandy says if you got something good in Florida, you can market it to his group. They are multinational. They work in Canada. They work in the U.S. They represent international business interests that really span the globe. So Rick, Sandy, and Amit are very capable, and they are interested in your assets in Ontario. If you want to reach out to us, we can connect you both. When will I be back in Orlando? I'm going to be back in Orlando first quarter of 2023. Hard to even believe I'm saying that. But it's going to be about 1 year from now. We just were in Orlando about 2 months ago. Had a great event, really, eye-opening, and it was wonderful to be at the tail end of COVID. Scott, tell me a little more about the Commercial Hub and how it can help me. Well, the Commercial Hub it's an online platform that allows you to do your evaluations, to do your due diligence, check your demographics, your mapping, break down your rent rolls, your income, and your operating expenses, etc. It'll also help you track many, many, many deals of every category, every variety, and then to be able to share those with potential would-be partners. So again, those are excellent tools. And in my humble opinion, and this is going to sound self-serving, and it's certainly not intended to, there really isn't anything like it out on the marketplace. It does unlimited rent rolls, unlimited what-if scenarios, unlimited financing scenarios, amortization tables and schedules, capital stack builders, virtual visits, due diligence folders that you're going to be able to put together for obtaining financing or partnership or even negotiating. So, really, really powerful stuff. What will I learn at the Colossal Cash Home Study course? Well, ladies and gentlemen, Colossal Cash is really a remastering, a digital remastering with video companions that talks to you about really everything from probably an introductory level to an intermediate level on commercial real estate. We talk about office, retail, apartments, warehouse, and a little bit of even land development. It talks to you and walks you through my 7 moves to checkmate. It shows you what to look for. And then beyond that, it gives you the opportunity to come on back and review those lessons over and over and over again. We're going to teach you how to find it, how to evaluate it, how to negotiate it, how to present your offer, how to conduct due diligence, how to go ahead and structure your offer and raise your capital to put together the capital stack, how to manage it towards your exit strategy, and then how to decide whether or not you're going to stabilize it and hang on to it, or whether you're going to stabilize it and flip it, or whether you're going to leverage it and and just let it ride off into the sunset, and many, many other aspects that you could pursue as well. All right. Also, Scott, do you still partner yourself on deals? I do still partner on deals, very selectively. Usually with folks that I know incredibly well. I am willing to be a junior partner on deals, and it's definitely something for me that I like because it adds value. It allows me to empower others and to drive them towards maybe being their best selves. The folks that kind of have me sit on their board for an equity stake, usually somewhere in that 5 to 15% range, know that they've got me on speed dial and they call me for anything. The reality is that most of them don't call all that often, but we're certainly happy to answer questions, and we do it really 24 hours a day, 7 days a week, 365 days a year. And for those that I'm involved in deals with, I mean, there may be times when I'm unavailable, we get right back to you. So it's definitely something I do. There are things that can be brought to the table: talent, expertise, network, financing, and execution. And, at times I bring all of those to partnership. Joseph says, first of all, congratulations, brother. Hopefully you're getting ready to close. Thanks for having us on this live session. What are your thoughts on redevelopment of old gas stations to a national drive-through on a busy, hard corner signalized intersection? Well, doggone it, Joseph, if you haven't just talked about one of the sexiest opportunities in the marketplace. These are things that I love. Mitigation of environmental concerns are something that I do on the regular because so many people are afraid of them. I'm happy to do them, not intimidated at all. It's just a process that you have to go through. I loved hard corners. I love signalized hard corners. I have excellent tenant relationships for drive-throughs. I'm currently working with Wendy's, McDonald's, Burger King, Starbucks, Chick-fil-A, DoorDash, Sheetz. Hang on, there's a couple more. Bank of America, Chase Bank, multiple municipalities, Taco Bell, Arby's. I know there's one more I'm forgetting right now. DoorDash. There's even one more. If I didn't mention Raising Cane's. And that's just to name a few right now. CVS is an out-parcel user that we're looking to work with, talking to Walgreens right now. So just really a tremendous amount of those hard corner, single-tenant net lease arrangements that really are one of the crux of what we're going to be talking about in Las Vegas. It's something I'm really excited about. I only recently started teaching folks this, but it's something that I've personally been focused on a lot for the last, call it, 7 to 10 years. Kind of linking these things together and cherry picking them and putting these ground leases in place that pay you for 20 to 60 years, and doing so where the tenant brings almost all the value and it's able to be leveraged almost 100%. You can option these deals in a way that gives you the ability to control them until you bring a tenant, and so it really does afford a lot of unique benefits that you can't find in a lot of other assets. Faria wants to know, how do I market to the Lotus Group? Grace Hayes and I would love to send you a deal. I know that's tongue-in-cheek, so I will leave that to the two of you. Scott, what are your thoughts on light industrial as an asset class? Are we at the peak, or is this going to run through? Is this going to continue through for X number of years? Again, it really is deal specific. I wouldn't criticize or I wouldn't praise any one asset class over any other, except to say that there's times when venture capital and the capital markets are chasing one asset class over another, which is what always tends to empower a run-up in values and a compression of cap rates. So what ended up happening was in the middle of the last decade, capital started to dry up and get a little fatigued on retail and central business district office and hospitality. And so because of that, they needed to continue to move money, because only when they move money are they able to take their percentage of their fees. And fees are how they live. So if they're going to eat and they're going to live and put food on the table, they got to be doing business. And so they found some undervalued asset classes that they could start up in that 12 to 14% cap rate and slowly shave away the various layers of the onion until they got down to where it really doesn't even make sense anymore. There is literally no way that the asset classes that are yielding 4 and 5 caps today in Class C, multifamily or storage facilities or small bay industrial or mobile home parks compete with blue chip stocks, which typically get you that same 3 to 5% return. They don't. But because there are so few places for people to put their money, because interest rates in institutions are really nominal, many people feel that the stock market is completely overheated with price to earnings ratios, pressing up on 50 times, meaning 50 years of this revenue is what you're buying the asset class at. So it feels like it's maybe a little overpriced, and it probably is. So that's what has caused the run. You kind of built a trench and the water had to flow through it, but the dirt comes with the water, and that's starting to fill back up. And I think you're going to start to see over the next 1 to 2 years that many of these asset classes that were at the peak and had historic runs and historic highs are going to start to wane a little bit. But you can always find assets in every class that makes sense, and certainly in light industrial, if it's the right property in the right area with the right amount of users that's manageable for you, and you get it at an effective costing basis, you can make that work no problem. I have no challenges with that whatsoever. Scott, can you walk through one of those corner deals that you've done over the past 12 months? Are they easy to put together? Must be hard to find a tenant to lease up with. Well, Ashley, here's the reality of that. They aren't. If you've got the right location, you can do quite well with it. The problem is that in a lot of instances, there are mitigating factors. Maybe you don't have the right volume of space, and maybe you don't have the proper curb cuts, or you don't have the proper traffic flow, meaning, look, you can only get there with a U-turn, or, the traffic travels by at 50 miles an hour and you really need 25 miles an hour to make the sharp right-hand or left-hand turn to get into the facility. But if you've got an asset that's appropriately sized and properly located, finding those tenants can be relatively straightforward. But once you've done it, it becomes a lot easier. So if you've never done it, you're right, it does take a little longer because they want to make sure that they're dealing with a developer who knows what they're doing, that isn't going to shrivel or wilt at the first sign of trouble because you don't have geological stability, right? Your soil isn't compacted to be able to support this, and you got to remove that soil and bring in engineered fill. Or you don't have the right zoning, and then you got to be able to present to the zoning committee to get either the conditional use permits or the zoning variances. Or maybe you don't necessarily know how those economics will work, and so they want somebody who understands what it is to build and develop and give them a turnkey solution for a corporately backed guarantee that's going to last 20 years with 8 5-year options. I'll give you an example of maybe a tougher deal that I did. I took a former Packard dealership, the Packard Automotive Company that used to make cars back in the last century, went out of business in 1962. So this was an automotive dealership. Back in the 60s, when you changed your oil, when you were done draining the engine, you tossed it out the back. So it had environmental problems. It had buildings with lead paint and asbestos and geological issues and a cistern underneath the parking lot. It had a party wall that was shared with another building that needed to be demised and demolition. But you got to knock down one building while preserving a common wall with another building. So there was a lot of challenges to it. But eventually I was able to take that and an AMCO transmission center right next door. I was able to assemble those, knock down both buildings, bring in engineered fill, get it rezoned for retail, took that retail and marketed that to Wendy's, put together a 20-year Wendy's ground lease, corporately backed from a large franchisee who was the president of the National Wendy's franchisors. For the last 5 years, they've since retired from that position. We built it for him turnkey, got it entitled and approved. I bought the land for around $300,000. I had $300,000 in what's called curb-in site preparation. Turned it over to the tenant with about a $600,000 investment. We sold it at a 4.8 cap. I planned on holding it forever, but the cap rate was just a little too attractive. We walked away and we made a little over $1 million on that one, and it was just a fairly straightforward deal. Brandon Souter, good to see you, buddy. I have a small industrial triple net for $2.1 million. It's a 7 cap, 4 more years on the lease. No escalation of the lease. Cash on cash is only about 9%. I could sell it for $1 million or more right now to an owner user if a tenant vacated, but it's leased for 4 more years. I could use some depreciation to lower my taxes, but is it worth waiting 4 years for a payoff and risk demand dropping? Well, I would tell you that it really does matter, Braden. Does it make sense for you to hold it is really more of a specific question. And, as one of our team members, certainly send that in and I'll give it a slightly deeper dive to give you a sense as to whether or not I feel like, you've got the ability to capture a new tenant in the event that this tenant goes away. If you certainly, do want to sell it, that's an option. But, 7 cap, it really depends on the quality of the tenants that there and the rents and what you're yielding to determine whether or not it makes sense. 9% cash on cash is really not terribly attractive, especially if there's no real upside. And the only way to get there is through a 4-year hold period. because we do know that interest rates will be higher, on down the road. Bobby again, Scott, how would you answer if a broker asks, is this your first deal? Obviously say yes. But how do you say that you're cutting your teeth? Well, it depends on what you've done before. If you've been successful in, let's say, residential investment, then you want to let them know that. If you indicate that you are, brand new to the game, ask for some of their guidance. You're not going to fool anybody if you've never done this before. They're going to know categorically, without any hesitation, within a handful of questions, that this is your first shot. So if not only are you inexperienced, but you're not truthful, then the likelihood that they're going to want to work with you and support you is going to become pretty thin. And if you find that your inexperience or your risk tolerance isn't there because you've never done this before, then that's another reason to get to one of our live events where you can start to shadow some folks who are doing it, gain confidence and competence. And when you find a good deal, even if you're not comfortable taking it down yourself, you're going to be able to find people in our network and our organization who are going to be willing to step up with you to help you put those types of deals together. Again, if it's the right deal. If it's the wrong deal, the lack of interest is going to dictate and indicate to you why there is a lack of interest. Mike Gregel says, great information, Scott. Thank you so much. Mike, my pleasure. Glad to help. All right, Mark Prideaux. Recent Market and Millichap Outlook highlighted that senior housing and assisted living, as long as good long-term prospects, sounds like it's good with good management in place, but it's also a passive investment otherwise. Or does it come with other issues like owning an apartment building? Well, it does. Senior housing and assisted living properties come with incredible liability. And typically with those types of properties, you have to have an operator. So you're really like a sub-tenant. So it's not like multifamily where, you buy it and then someone comes and they rent from you and they just pay you and they live their own lives. In these environments, you're providing a service. And so there's a service provider. There are bed licenses that are needed to be acquired. Those are licensed from the state through credentialed individuals with, nursing licenses, healthcare practitioner licenses. So you'll almost always want to marry up with some of those in an assisted living. In senior housing, as long as you're talking about a 55 and over community where you're dealing with folks who are competent, capable, and certainly self-sufficient, then there's no problem. You're just kind of keeping the kids out and maybe some of the riffraff. So senior housing can really work and can be something that is very powerful. All right, guys, we're getting down to near the end here. Got about another 3 to 5 minutes before we sign off. It's been a lot of fun talking with you about things that are going on, and again, pretty informal. This was the first time we've done one of these. If you guys like it, please be sure to let our team know. We're going to be happy to continue to engage you on these types of platforms, but I got to tell you, nothing really beats being in the environment and not only spending time with myself and my team, but so many of our clients and our students who've been successful out there doing it. When you rub elbows and you press the flesh, shake hands, talk with them, and hear the details of what their life and experience has been like since commercial real estate has entered their investment strategies. It's a game changer. And to me, the proof is in the pudding. You've got to be willing to take the risk to get out there and to take the actions necessary to become present, prudent, and productive in this space. And if you'll do that, your success in commercial real estate is a win, not an if, as long as you don't quit. All right, Scott, let me talk to you about, again, let me ask you, is this bonus live experience important for me to attend in Vegas in May, or can I wait for another event? Well, May is important. Maybe more so now than ever because of the way that interest rates are fluctuating, the way that markets are starting to run for the exits, the way that there's been disruption in the stock market, the way that inflation is starting to really creep in, the laws of supply and demand. Certainly the stimulus is starting to run its course, so a lot of folks are going to find themselves in a position where they're running out of capital. So to me, getting there sooner rather than later is what's going to prepare you to be first in line when those opportunities, CMBS defaults, let's call it just turn-in deals. Somebody doesn't have recourse, but they're done with the deal. The bank doesn't want it, the investor doesn't want it, so they just flip it over, and now that's your opportunity to step in and do again, very, very, very good work. John Brinko says, thanks again for the wisdom, Scott. Best decision I ever made was to join your team. Well, thank you, sir. We're grateful to have you. You know how we feel about you. You've been an excellent partner to so many, and we look forward to working with you. Rosa, it is great to be back, and I appreciate you being here with me, darling. Thanks so much. Scott, it really seems like now is a dangerous time to get into commercial real estate. Why do you think it's a really good time? Well, I know it's a good time. I don't think it's a good time. I don't mean to be overly confident, but the truth is that this is what I've been waiting for. I think it's been a hell of a lot riskier over the last 3 to 5 years, people buying in at these compressed cap rates. Now, a lot of people got in and got out, and that was great. But, you know, when you buy at a 4 cap with 3% interest rates and a 1.2%, debt coverage ratio, you put yourself in a position where even the slightest shifts in the market put you right in the crosshairs of default. And I know a lot of people who over invested. They got a little hypercharged over the opportunity to place capital, because certainly capital has been easier to form over the course of the last 3 to 5 years than it's been maybe historically. I think that's going to continue to be the case, so that you know. I think that crowdfunding is going to start to take the place of banking institutions when it comes to commercial assets and the way that capital is formed there. Scott, I don't have a lot of money to invest. What do you say? This really isn't an obstacle. Is that true? No, look, when I got started, no money, no credit, no experience. You've got 3 ways of doing it. You can get partners who can bring capital. You can use seller financing. You can find and bird dog deals and become a junior partner where you get equity for doing some of the legwork. You can get equity for some of the management skills that you may bring to the table. So not at all a problem. If you have money, if you have credit, if you have experience, well, it expands your strike zone. But, you know, for someone to tell you that because you've never done this before, or you need to start small, or you need to start in residential before you get into commercial real estate, or, you know, you need to go out and make money first and get a bunch of capital on the sidelines before you get involved in commercial, or because you don't have credit, that you shouldn't do this, and these are reasons to forestall getting involved and getting busy now. Bullshit. That is simply not legitimate. There is no reason for you not to start to educate yourself, to get prepared, to start lining up your potential partners, your potential capital partners, your potential lenders, to create those broker relationships, to start learning your marketplace and your asset classes. There's never a better time than today, and I've said that every day that I've been in this business for nearly 30 years. Today's the best day because it's the one you can act on. There's nothing you can do to change yesterday. Tomorrow may never come. So get involved today, because now is when you can lay the foundation for that dynamic future that you deserve. And, you know, if I had waited for the perfect day on the perfect property with the right seller who took my offer exactly as I had wrote it, with all of my terms, and I waited for the perfect, day when the sun was shining and the birds were chirping and my dog licked me and my kids hugged me, well, guess when that day would have come? Maybe never. So you get in there and you make adjustments, you make modifications. You get more aggressive on deals that make sense. When you get hungry and you find something that really excites you, go after it with passion. And if you'll do that, you'll get it. And if you're meant to have it, you will have it. There's nothing that anyone can do to prevent you from your destiny. God wants amazing things for you in your future. You've just got to be willing to go out and pursue it, and you got to want it in your core. And if you'll do that, it only takes one deal, one time to change your life forever. And to me, that is the central thesis of everything that we do. Focus on what you want, put a plan of action into place, and then go make it happen. And if you'll do that, ladies and gentlemen, your success story is going to be written among the thousands and maybe tens of thousands that we've had written over our career of helping people over the last 21 years. Hopefully I'll get to do it for 21 more years, because I really, truly do love it. It's been a pleasure spending this time with you today. I thank you all for being here. I thank you for your faith, your confidence. But most importantly, I want to encourage you to have faith in yourself, to know that even though you don't have it all figured out, that if you get started, that you will eventually figure it out, that you've got a lot of folks like myself, my network, my colleagues, my team, who are going to be there to help guide you through those moments of uncertainty so that you can truly, in the moment, take action. Again, it's been a huge blessing to serve you today. May God bless you. May God bless the United States of America. Ladies and gentlemen, peace out. I'll see you in Vegas. Don't miss it. See you soon.